Okay, let's unpack this. We're doing a deep dive today into something really fundamental for any business, how it tracks what's actually happening financially. We've got some great source material here laying out record keeping, financial reporting.
The essentials.
Exactly. And our mission really is to get past just the definitions. We want to understand the story these records tell,
Yeah.
about a business's health, its performance,
Right.
and why getting this right isn't just like admin work, it's vital for survival, for growth.
It really is. You could call it the internal language of the business itself. It feels like paperwork, sure, I get that.
Yeah.
But it's the actual data that fuels every big decision. It shows you the reality, not just what you think is happening. Without a good handle on your records, you are basically just guessing.
And guessing is, well, not exactly a winning business strategy, is it?
Not usually, no.
So where does this whole story begin? The material we looked at is really clear. Organization, that seems to be the absolute starting point, non-negotiable.
It is. It's the foundation. You have to think of it that way.
Okay.
If your records are a complete mess, then any reports you try to generate later, they'll be useless. Or even worse, they could actively mislead you.
Right. Bad data in, bad decisions out.
Precisely. And there's also a very practical, non-optional reason, too. You've got a legal obligation.
Ah, okay. The law.
Yeah, tax authorities like the ATO here, they require you to keep records for at least 5 years. And that covers everything, all your income, all your expenses, tax invoices, receipts, bank statements, contracts.
5 years. Wow. That's quite a commitment. But it sounds like it's not just about keeping the tax office happy.
Oh, not at all. Not even close, actually. That 5 years of data, it's incredibly valuable for you, the business owner.
How so?
Well, it's your source material for understanding how you're actually performing. You spot trends, see what's working well, what maybe isn't.
Like, are sales of one thing going up? Or are costs creeping up somewhere?
Exactly that. Are your utility bills suddenly higher than last year? Why? The records hold those initial clues.
And I guess if you ever need money, like from investors or a bank loan, you've got to be able to show them a clear picture, right? Proof of your financial health. These records are that proof.
Precisely. You can't just walk in and say, yeah, we're profitable. You need to demonstrate it with a documented history. Cold, hard facts.
Okay. The material also mentioned something about electronic storage versus paper. Is that straightforward now?
Yeah, mostly. The tax office is fine with electronic records. But the really crucial bit there is security and backup.
Ah, good point.
Losing 5 years of your financial history because a hard drive failed, that's a business nightmare you really, really want to avoid. Regular backups are key.
Okay, so organization is fundamental. Understanding why you're doing it is key, but I can still see how this might feel overwhelming when you're just trying to run the business day to day.
Sure.
So how do we actually start capturing all that activity? Where's the ground level?
That brings us to the very first layer, source documents.
Source documents.
These are basically the original bits of proof, paper, digital files, whatever. They provide the solid evidence that a financial transaction actually occurred.
Like what kind of things?
Yeah.
Specifically, what should people be looking out for keeping?
Think about the really common stuff. You sell something. It's the cash register docket, maybe the EFT POS slip.
Right.
You buy something for the business. It's the purchase invoice you get from your supplier. Credit card slips, too. Those are the raw data points.
Got it. They're the proof. And they generally contain similar info.
Yeah, most source documents will have the key details. The date, who was involved in your business, and the other party, what was actually bought or sold, and of course the amount of money involved.
Right.
Every single financial event should ideally have a source document backing it up. And businesses obviously need to keep copies of the ones they issue to customers, like sales receipts.
So you collect all this evidence, these bits of paper or files. How do you start making sense of, a big stack of dockets and invoices? Seems chaotic.
It can be. That's where you consolidate them into journals. Journals are basically chronological logs.
Like a diary.
Sort of, yeah. A financial diary. You take the info from those source documents and you record a summary of each transaction. Maybe daily, maybe weekly, depends on the volume. It keeps track of when money moves in or out.
And the material we looked at specifically highlights one journal as being particularly vital, the cash book.
Yes, the cash book. Absolutely fundamental, especially for smaller businesses, keeping tabs on cash. It's a dedicated summary of all your cash receipts, that's money coming in, and all your cash payments money going out.
Okay.
And it's compiled directly from those source documents related to cash.
And its structure sounds pretty simple.
Very.
Yeah.
Usually, you literally have two sides, or two main sections. Cash receipts on one side, off on the left, cash payments on the other, the right. Simple columns for date, details, amount.
What's the real payoff for a business owner keeping this cash book diligently? Why not just, look at the bank statement at the end of the month?
Immediacy and control.
Mm.
The cash book gives you, like, instant visibility, categorized visibility. You can see right away how much cash came in today, how much went out on, say, supplies versus wages.
Right. Much more granular.
Exactly. It gives you really tight control over your cash flow,
Yeah.
helps you monitor your liquidity that's, the actual cash you have readily available, and it lets you figure out your current cash balance right now without waiting weeks for a bank statement.
Yeah.
It's like taking the pulse of your cash position.
Okay, that makes sense. So we start with the evidence source docs, then we organize it chronologically, journals, especially the cash book, and that gives us control over the daily flow. But how do we step back, look at the bigger picture? How do we actually know if the business is making money, over a stretch of time?
Right, and that's exactly when we move from the day-to-day tracking
Yeah.
to the main financial reports. And the first big one is the income statement. You might hear it called other things too, revenue statement, or maybe most commonly, the profit and loss statement, P&L.
P&L, right. Heard that one.
Its main job, its core purpose, is to help a business calculate its net profit or maybe a net loss for a specific period. Could be a month, a quarter, a full year. It tells the story of your business's performance during that time frame.
What kind of story does it tell? What specific information is in there?
It basically lays out three main things. First, your total income or revenue, all the money earned from your main business activities.
Like a cafe selling coffee and food.
Exactly. Or the example in the material, Globe International selling apparel, that's their revenue. Second, it lists all the costs and expenses you had to incur to earn that revenue.
Okay, money in, costs out.
Yep. And finally, it shows you the result. Did you actually make a profit, or did you end up with a loss for that period?
So it takes you from the top line, the sales, right down to the bottom line, what's left over.
Precisely. The calculation usually starts with revenue. Then, and this is specifically for businesses that buy and sell goods, what we call trading businesses.
Not service businesses.
Right. Not typically for pure service businesses like, say, a consultant. For trading businesses, you subtract the cost of goods sold, or COGS.
Okay, COGS.
And that gives you your gross profit. Think of gross profit as like the markup you made on the products themselves before you factor in all the other running costs.
Right, so gross profit isn't the end of the story. What's next?
No, not at all. Next, you list out and subtract all your operating expenses.
And those are?
Those are the everyday costs of just keeping the doors open, running the business. Things like wages, rent, electricity, phone bills, marketing, maybe postage, vehicle costs, all the essential overheads.
Got it. And subtracting those gets you to the real profit.
Yes. Gross profit minus all those operating expenses equals your net profit.
Yeah.
And the material points out net just means simply that all the relevant expenses have been taken away. This net profit figure.
Yeah.
That's the true profit the business generated from its operations during that specific period.
That final number, net profit, seems incredibly important. Why is it such a big deal for the owner?
Well, fundamentally, it's the return on their investment, right?
Yeah.
Their time, their money, their effort.
Sure.
That profit is what can be taken out by the owner as their reward, their income. Or, crucially, it can be plowed back into the business, reinvested.
For what? Like growth?
Exactly. To fund future growth, buy new equipment, maybe hire more staff, expand into new markets. It's a direct measure of how successful and efficient the business is financially.
And just looking at the income statement lets an owner ask some really sharp questions about what's going on.
Absolutely. It forces you to analyze things. Is our revenue high enough?
Yeah.
Is the markup, the gross profit margin, actually sufficient? Are the operating expenses getting out of hand compared to the revenue we're bringing in? And comparing income statements over several periods, month to month, year to year, that's where it gets really powerful. It shows you trends.
Like if sales are up but profit is down?
Perfect example. If revenue is rising but net profit is falling, immediately you need to dig into those operating expenses. Or maybe your pricing isn't right. It tells a story about efficiency or lack thereof.
Okay, so the income statement is the performance review over a period. But what about getting that snapshot, like a picture of the business's financial health right now at a specific moment?
That's the job of the other major report, the balance sheet.
Balance sheet, right.
And the key phrase you'll always see on a balance sheet is "as at," followed by a specific date. December 31st, June 30th, whatever.
So not over a period, but at a point.
Exactly. It's like taking a financial photograph of the business on that one particular day. It shows what the business owns, what it owes, and what the owner's stake actually is. It reveals your financial position, your stability.
What are the main parts of this photo?
It boils down to three core elements: assets, liabilities, and owner's equity.
Okay, let's break those down. Assets first.
Assets are basically everything of value that the business owns. The material used Globe International as an example again.
Yeah.
So this includes things like cash in the bank, money that customers owe you, that's called receivables, or debtors your stock, or inventory waiting to be sold, any dues you've paid in advance, like insurance haul.
Yeah.
Those are prepayments. And also longer term, things like buildings, equipment, vehicles, anything valuable the business controls.
Okay, so stuff you own. What about liabilities? That sounds like the opposite.
Pretty much. Liabilities are what the business owes to other people or organizations. It's debts and obligations.
Like,
Well, the Globe example mentioned things like money owed to suppliers, that's payables or creditors, any loans, lease obligations for property or equipment, tax bills that are due but not yet paid, maybe money set aside for employee leave, things like that. These are claims against the business's assets by outsiders.
got it. Assets are owned, liabilities are owed. What's the third piece?
Owner's equity.
Yeah.
This represents the value of the business that actually belongs to the owner or owners.
How's that calculated?
It's essentially what's left over when you subtract the liabilities from the assets. It's sometimes called proprietorship or capital. It reflects the money the owner initially invested, plus any profits the business has made over time that haven't been withdrawn. It's the owner's stake.
And these three things, assets, liabilities, owner's equity, they're linked by a really core principle, aren't they?
Absolutely. Critically important. It's the fundamental accounting equation. You've probably heard it. Assets, liabilities, plus owner's equity.
Right.
This equation must always hold true. The total value of everything the business owns must equal the total claims on those assets, which are the claims of the creditors, liabilities, plus the claims of the owner, owner's equity. It has to balance. It's what's called a balance sheet.
Okay, that makes sense. Everything the business has must have come from somewhere. Either it was borrowed, liability, or it was put in by the owner, equity.
Exactly.
And comparing balance sheets over time, say year end to year end, that tells another kind of story.
It does. It shows you how the whole financial structure of the business is evolving. Is the business taking on more debt? Are liabilities growing faster than assets? Is the owner reinvesting profits, causing equity to increase? Is the overall value of the assets going up or down? Comparing them helps you evaluate the overall financial health, assess risk, like how much debt you're carrying relative to equity, and supports longer-term strategic decisions.
You can see if things are getting potentially risky, maybe too much debt.
For instance, yes. If liabilities are ballooning while equity is stagnant or shrinking, that's a warning sign about financial risk.
Wow. Okay, so we've gone from the tiny seed of a single transaction's evidence.
The source stock?
Right. To organizing it, tracking the flow with things like the cash book,
Keeping tabs day to day,
then calculating performance over time with the income statement,
seeing if you're making money.
and finally getting that snapshot of overall financial health with the balance sheet.
What you own, what you owe, what's left.
It really does build a complete picture, but managing all of this, it still sounds like it could be a lot of work, especially for a small business owner maybe wearing lots of hats.
It can be, absolutely.
What practical strategies did the source material suggest to make it more manageable?
Yeah, it offered some really sensible, actionable steps. First off, think about technology.
Software.
Right. Bookkeeping software, it mentioned examples like MYOB, Xero. QuickBooks can automate a huge amount of this. Recording transactions, generating those reports we just talked about, it can save a ton of time.
But maybe there's a learning curve, or it feels complex to set up.
That's true, which leads to the second strategy.
Yeah.
Don't be afraid to get help.
Like hiring someone.
Exactly. Hiring a professional bookkeeper, maybe part-time, even just a few hours a week or month. If you really lack the time or the specific skills or just the confidence to get it right yourself, it can be money very well spent. Avoid costly mistakes later.
Makes sense. What else helps just keep things under control day to day?
Simple stuff, but crucial. Have a really good filing system, whether it's folders and boxes or digital folders on your computer, and process those documents regularly. Don't let invoices and receipts just pile up on your desk for months until it becomes this huge, overwhelming mountain.
Yeah, procrastination is the enemy here.
Totally. Keep your record-keeping system as simple as you can while still making sure it's complete and accurate. Be organized. Don't let these duties build up.
And there was one point that seems almost too obvious, but maybe people forget.
Oh yeah, absolutely essential. Do not mix your business finances with your personal finances, ever.
Separate bank accounts.
Definitely. Separate bank accounts, separate credit cards if possible, separate records entirely. Mixing them makes tracking everything accurately a nightmare, especially for tax time and for actually understanding your business performance. Keep them separate, full stop.
Good advice. Always get those documents, record them promptly. And if you get really stuck or you're just not sure about something tax related,
The material pointed out there's often free help available. Official bodies like the ATO have hotlines, tons of info online, sometimes even workshops or visits. Use those resources.
or pay for expert advice.
Or, yes, engage a registered tax agent or an accountant. They charge fees, of course, but they have the professional expertise to make sure everything's done properly and you're meeting all your obligations.
That's a really comprehensive journey then, from the ground level, the proof of one transaction,
The source doc.
all the way up to these key reports,
Yeah.
the cash book for flow, the income statement showing performance over time, the balance sheet giving that snapshot of health, and practical ways to manage it all.
Yeah, it demystifies it a bit, hopefully.
It definitely transforms what can seem like really dry admin into, well, into a powerful tool for actually understanding and steering the business, doesn't it?
It tells you where you've been, financially speaking. It tells you where you are right now. And critically, it gives you the solid information you need to decide where you want to go next.
And it really leaves you thinking, doesn't it? This whole structure, tracking performance over time, capturing financial position at a point in time. You have to wonder how understanding these core principles might apply beyond just traditional businesses. Could you use this kind of framework to analyze other kinds of ventures, or maybe even get a much clearer, more structured handle on your own personal finances? Something to ponder.